In the spring of 2009, a woman named Carol was sitting at her kitchen table, staring at her bank account. She had spent 7 years saving $50,000. It was supposed to be her house down payment. The plan was clear. The timeline was set. And then the financial world fell apart. The S&P 500 had lost more than half its value. Banks were collapsing. The news was running the same terrifying headline on a loop. Worst economic crisis since the Great Depression. Her co-workers were pulling money out of their retirement accounts. Her neighbor had already sold everything and moved to cash. The general consensus among everyone she knew was simple: stay out until things calm down. Carol did the opposite. She took that entire $50,000 and put it into a basic S&P 500 index fund. Not a hot stock tip. Not a complicated strategy. Just the broad market, at a moment when everyone around her thought the market was finished. Her husband thought she had made a serious mistake. Her sister called twice, trying to talk her out of it. Her closest friend at work told her she was gambling with money she couldn't afford to lose. Carol held the position anyway. That $50,000 is worth approximately $590,000 today. No stock picking? No timing tricks? No financial genius involved. She simply looked at the fear around her and recognized something most people couldn't see through the panic. That moments like that one are rare. And the people who act while everyone else is frozen are almost always the ones who end up on the right side of history. Now here is what I need you to sit with for a moment. We are living through something similar right now. Not a market crash. Not a single dramatic moment you can point to on a chart. Something quieter? Something slower. Something that most people will only understand clearly in hindsight, when it's too late to position for it. A transfer of wealth so large, the number almost doesn't feel real. $124 trillion. That is not a rounding error. $124 trillion is changing hands over the next 2 decades, the largest movement of wealth in recorded human history. And the overwhelming majority of people have no idea it's happening, let alone what to do about it. Today, I'm going to break down exactly what's unfolding, why the conditions echo some of the biggest wealth creation moments America has ever seen, and the specific moves regular people are making right now to make sure they end up on the receiving end of what's coming. Let's start with what happened after 2009, because it tells you everything you need to know about how ordinary people build real wealth. After Carol bought in, the market didn't just recover. It launched into the longest bull run in American financial history. From the bottom in March 2009 through January 2026, the S&P 500 climbed over 900%. The index recently crossed 7,000 points for the very first time. $100 invested at the low became roughly $1,000. But the people who built the most wealth during that run weren't hedge fund managers. They weren't day traders or Wall Street insiders. They were nurses, teachers, plumbers, office managers, and small business owners who simply kept contributing to their 401ks and IRAs while everyone else was scared into inaction. The numbers tell the story. In 2010, the United States had approximately 8.4 million millionaire households. By the end of 2024, that number had nearly tripled to almost 24 million. The country produced over 15 million new millionaire households in just 14 years. Think about what that actually means. Roughly the entire population of the New York metropolitan area crossed the $1 million threshold in less than a decade and a half. Who were these people? The vast majority were not founders who sold companies or executives who cashed out stock options. They were regular people who simply participated in the market's rise through consistent investing over time. According to UBS's Global Wealth Report, released in 2025, the United States added 379,000 new millionaires in 2024 alone. More than 1,000 new millionaires every single day. Not through windfalls, not through luck, through the steady, boring, unglamorous accumulation of assets in rising markets. UBS has a specific name for this group. They call them everyday millionaires, people with between $1 million and $5 million in net worth. Globally, this group has quadrupled since 2000 to approximately 52 million people, collectively controlling over $17 trillion in wealth. The path to joining them is not a secret. It is documented and repeatable. And what is coming over the next 25 years is about to create more of them than any previous period in history. So what exactly is the Great Wealth Transfer? According to Cerulli Associates research published in 2025, approximately $100 to $24 trillion in assets will change hands between now and 2048. This is the largest intergenerational wealth transfer ever recorded. Nothing in economic history comes close. To make $124 trillion feel real, it exceeds the combined annual economic output of every country on Earth. It is more than 5 times the current U.S. national debt. It represents 8 decades of American economic expansion about to flow through the generations in a compressed 25-year window. Here is the basic mechanism. Baby boomers, people born between 1946 and 1964, currently control approximately 52% of all wealth in the United States. That is roughly $78 trillion sitting in the hands of one single generation. The youngest boomers turned 62 this year. The oldest are approaching 80. Over the next 2 decades, that wealth moves to their children, to their grandchildren, to charitable organizations. Cerulli's breakdown puts it this way. Approximately $16 trillion flows directly to heirs. Another $18 trillion goes to charitable organizations. Generation X stands to inherit approximately $39 trillion over the next 25 years. Millennials will receive approximately $46 trillion. And even Gen Z will begin seeing significant inheritance money as the transfer accelerates through the 2030s and 2040s. The timing of all this matters more than people realize. Gen X, the generation that somehow always gets overlooked in these conversations, will receive approximately $1.4 trillion per year over the next decade. This arrives right in the middle of a difficult life stage for many of them, caught between aging parents who need care and their own kids who still need support. For a generation whose retirement outlook has looked uncertain for years, this wave could completely rewrite the picture. Millennials face a longer wait but a larger eventual total. The $46 trillion heading their way will land as many of them enter their peak earning years, which means inherited capital starts compounding on top of career income at the same time. That combination produces results that are hard to overstate. Now here is the part that most people get wrong about the Great Wealth Transfer. And getting this wrong is exactly what causes people to dismiss it as irrelevant to their own lives. This is not primarily about inheritance. Cerulli's own data shows that approximately 62% of the wealth being transferred will come from high net worth and ultra-high net worth households, and those represent only about 2% of all households in the country. The transfer is concentrated. A relatively small number of families will inherit enormous amounts. Most families will inherit modest sums or nothing at all. If you are waiting for a life-changing inheritance check to arrive, that is a weak strategy. Most people will not receive one. But that is not the opportunity anyway. The real opportunity is what the movement of $124 trillion does to the economy around you, regardless of whether any of it comes directly to you. When trillions flow into investment accounts, asset prices rise across the board, which benefits everyone already holding assets. When heirs buy homes, real estate values climb, which benefits existing homeowners. When inherited capital gets deployed into new businesses, job creation accelerates, which benefits workers at every level. The Great Wealth Transfer creates conditions that lift multiple asset classes simultaneously, and those conditions benefit anyone who is positioned and invested, not just the people receiving the checks. The closest historical comparison is what happened after World War II. Returning soldiers used the GI Bill to buy homes, start businesses, and build the middle class that defined American prosperity for the next half-century. That wealth creation event produced the baby boomers, who are now the ones transferring the wealth. History is repeating, but at a scale that makes the post-war boom look like a warm-up. Let me connect this back to 2009 properly, because the parallels go deeper than most people notice. In 2009, three conditions lined up to create extraordinary wealth for anyone who recognized what was happening. First, assets were dramatically undervalued after stocks fell 57% from their peak. Second, a massive injection of capital was coming through government stimulus and quantitative easing. Third, most people were either too scared or too financially strained to act. The current moment has the same structure, even though the mechanism is entirely different. Markets are not crashed right now. But the transfer will create both opportunities and dislocations throughout the period. Some assets will be sold to settle estates on a timeline that has nothing to do with market conditions. Others will be redeployed by heirs who think about money completely differently than their parents did. That constant movement creates buying opportunities for prepared investors at multiple points across a 25-year window. The capital injection this time is not coming from Washington. It is coming from the wealthiest generation in American history, passing assets to their children and grandchildren. And the scale, $124 trillion, is 25 times larger than the entire pandemic stimulus effort, which totaled around $5 trillion. That comparison alone should stop you for a moment. Just like 2009, most people are not paying attention to this. The Great Wealth Transfer gets a fraction of the media coverage given to daily market movements, despite the fact that its long-term impact will be dramatically more significant. The people who became millionaires after 2009 were not smarter than everyone else. They were simply positioned when the opportunity showed up. That same principle applies right now. Let me walk through the specific dynamics you need to understand to actually benefit from what's coming. Dynamic 1. Where the money is going to flow. Research from Bank of America and Merrill Lynch shows that younger investors have fundamentally different preferences than the generation before them. According to their studies, 72% of investors between ages 21 and 43 believe it is no longer possible to achieve above-average returns using only traditional stocks and bonds. That is a generation-wide shift in investment thinking that will redirect trillions of dollars over the coming decades. Where boomers favored blue-chip stocks and bonds, their heirs show stronger preferences for alternative investments, direct stakes in private companies, and newer asset categories. Artificial intelligence infrastructure is already capturing enormous capital flows in 2026. The returns being produced by companies at the center of that build-out have been impossible to ignore. Clean energy, healthcare innovation, and digital assets are all positioned to receive disproportionate shares of redirected wealth as the transfer continues. This is not a call to abandon broad market investing. It is a call to understand that capital flows are shifting, and the sectors that attracted boomer money may not be the same. Sectors that attract the trillions of dollars their heirs will be deploying. Awareness of that shift, by itself, is a competitive advantage. Dynamic 2. Real estate positioning. The Great Wealth Transfer will reshape housing markets in ways that vary enormously depending on where you are. On the demand side, wealthier heirs will be looking to buy homes. On the supply side, inherited properties will be entering the market. These forces will not hit every market equally. Markets where boomers concentrated, suburban areas, retirement destinations, certain Sunbelt cities, may see inventory increases that moderate prices as estates are settled and properties sold. Markets where younger, higher-earning people want to live, cities with strong job growth, technology investment, and quality-of-life factors that matter to the next generation, may see intensified competition as newly liquid millennials pursue homeownership. This divergence is already visible in the data. Home prices have risen over 150% nationally since 2000, but that appreciation has been wildly uneven by market. The same $500,000 deployed in a growing market versus a declining one will produce dramatically different outcomes over 20 years. Geographic awareness is a direct wealth-building input during this period, not just a lifestyle consideration. Dynamic 3. Staying invested through the noise. Carol did not need a sophisticated investment strategy in 2009. She needed two things: capital to deploy and the discipline to leave it alone when the news made that feel irresponsible. The market has delivered an average annual return of approximately 10% over long periods. Someone who invested $500 per month in an S&P 500 index fund starting in 2009 would have accumulated over $250,000 by early 2026, not counting any employer match. But that journey ran directly through some genuinely terrifying moments: the European debt crisis of 2011, the government shutdown of 2013, a full-scale trade war in 2018, a global pandemic that crashed markets 34% in 33 days in 2020, a brutal bear market in 2022. At every single one of those points, there were credible voices saying the rally was over. At every single one of those points, the people who stayed invested captured the recovery that followed. Goldman Sachs research puts a hard number on what it costs to try to time this. Missing just the 10 best market days since 2009 drops annual returns from approximately 17% down to roughly 12%. Missing the 25 best days cuts returns nearly in half. The most important detail: the best days in the market almost always occur during the most volatile stretches, when fear is at its peak and the temptation to get out is strongest. The great wealth transfer will not be a smooth, uninterrupted ride. Recessions will happen during the transfer period. Corrections will come. There will be moments when the headlines make it feel like pulling out is the only rational thing to do. If history is any guide, and it has been every single time so far, those moments will be the ones that reward the people who stayed in. Dynamic 4. The industries that grow when this much wealth moves. When $124 trillion changes hands, entire sectors expand to handle the process. Financial planning, estate administration, tax advisory, wealth management, legal services specifically around trusts and estates, real estate transaction volume. All of these areas will grow substantially and consistently over the 25-year transfer period. People who build skills in these areas, whether as a career, a business, or a professional side expertise, will find robust opportunity for decades. The numbers already show this happening. The share of millennial and Gen Z clients at high-net-worth-focused financial firms grew from just 8% in 2021 to 25% by 2024. Advisors who understand how younger clients think about money are building practices that will compound in value right alongside the wealth they manage. That pattern will only accelerate. Dynamic 5. The spousal transfer. This is the one almost no coverage bothers to mention, and it is significant. Cerulli estimates that approximately $54 trillion will pass first to surviving spouses before eventually moving to the next generation. Of that amount, nearly $40 trillion will go to widowed women. This creates one of the largest and fastest-growing markets for financial services in American history. Advisors, planners, educators, and product builders who develop genuine expertise serving this demographic are positioning themselves to capture business that will compound for decades. As women become the primary controllers of unprecedented levels of wealth, the financial services industry will have no choice but to reorganize around serving them well. Here is something nobody talks about when it comes to wealth creation events: how they actually feel from the inside while they are happening. The period after 2009 did not feel like a golden era while it was unfolding. It felt uncertain and fragile most of the time. Every crisis brought a new wave of predictions that the rally could not continue. Every market wobble generated another round of headlines suggesting the recovery was over. Yet the S&P 500 crossed 2,000 in 2014, then 3,000 in 2019, then 4,000 in 2021, then 5,000 in early 2024, then 6,000 by late 2024, then 7,000 in January 2026. The people who accumulated real wealth across that run were not the ones who made the best predictions. They were the ones who stayed in when staying in felt uncomfortable. The psychological challenge, not the intellectual one, was what separated the people who captured those gains from the people who missed them. The great wealth transfer will work exactly the same way. Long stretches of uncertainty, periodic sharp volatility, headlines that make now feel like the wrong time to be invested. The same human reaction that caused people to miss 2009 will show up again in different clothing. The mechanism changes, the emotional trap does not. Here are the concrete numbers that make this feel real. Take a 35-year-old today who invests $500 per month in diversified index funds for the next 25 years, roughly the full duration of the transfer. At the historical average return of 10% annually, that $150,000 in total contributions grows to approximately $665,000. At a more conservative 7% return, the outcome is approximately $405,000. Now factor in the tailwind from the transfer itself. If economic growth runs even 1 percentage point above historical averages because of the increased capital activity the transfer creates, 7% becomes 8%, and the 25-year outcome climbs to approximately $475,000. Increase the monthly contribution to $1,000, which becomes achievable for many people as careers progress, and the numbers scale up significantly. At 10%, annually, $1,000 per month over 25 years reaches approximately $1.33 million. Regular people hit millionaire net worth through consistency alone, with no inheritance required and no extraordinary income needed. These are not optimistic projections. They are what the math produces at historical averages. The transfer simply adds a tailwind to an already proven approach. Let me put all of this in historical context before we get to the action steps, because context is what makes the size of this moment real. America has experienced a handful of wealth creation events that moved regular people into millionaire territory at scale. The post-Civil War industrial expansion created the first generation of American millionaires, but it was concentrated almost entirely among industrialists and financiers. By 1900, the entire country had roughly 4,000 to 5,000 millionaires. The post-World War II boom created the first true mass millionaire class through housing appreciation, expanding stock, market participation, and corporate pension systems. Average home prices have risen approximately 500% since the early 1980s, when boomers were forming their first households. The bull market from 1982 through 2000 minted millions more as 401k accounts expanded and technology stocks delivered returns that had never been seen before. The S&P 500 rose nearly 3,000% from the beginning of that period. The recovery from 2009 through 2026 nearly tripled the number of millionaire households in the country as markets repeatedly reached new highs. Each of these events produced millionaires who simply showed up, stayed in, and participated. No genius required, no special access to information, no connections in high places, just presence, patience, and consistency over time. The Great Wealth Transfer is the next chapter in that story. $124 trillion moving over 25 years. Economic activity accelerating because of the capital being redeployed. Asset prices supported by the largest capital flows in history. Opportunities surfacing across real estate, equity markets, and adjacent industries throughout the entire transfer period. The question was never whether the transfer would happen. It is already happening. The oldest baby boomers are 79 years old in 2026. Wealth is moving right now. Every year you spend waiting for a better entry point is a year of compound growth that cannot be recovered later. So here is what the action framework actually looks like. Maximize your tax-advantaged accounts first. For 2026, the 401k contribution limit is $23,500, with an additional $7,500 catch-up contribution available for those 50 and older. Max out your 401k, max out your IRA, use your HSA if you qualify. These accounts allow wealth to compound without annual tax drag, eating a portion of your returns every year. During a 25-year wealth event, The difference between taxable and tax-advantaged compounding is enormous. Maintain broad market exposure. Do not try to identify which single sector will benefit most from the transfer. Own the entire market through low-cost index funds. As the $124 trillion flows into various investments over the transfer period, broad market exposure ensures you participate in the aggregate growth rather than making concentrated bets on specific corners of the market. Build skills adjacent to wealth movement, whether through a career pivot, a side practice, or simply professional knowledge that increases your value. Understanding finance, estate planning, real estate, or wealth advisory creates direct income opportunities from capital in motion. These skills will be in demand for the next 25 years, regardless of what the market does in any given quarter. Keep a cash reserve for opportunistic moments. The transfer will create dislocations, estates being settled under time pressure, inherited properties sold quickly by heirs who want liquidity rather than the asset. Having capital available when others are forced to sell has always generated above-average returns. That pattern will repeat throughout the transfer period. Think in decades, not quarters. This is a 25-year event. Short-term market movements are noise against that backdrop. The people who will benefit most are the ones who extend their time horizon and stop letting 90-day thinking drive 25-year decisions. Consider where you live as a financial decision. If you have any flexibility about location, research where wealth will concentrate versus where it will disperse as the transfer unfolds. Real estate in markets that attract younger, higher-earning residents may significantly outperform markets that are losing population over the next 2 decades. Have the family conversations that most people avoid. Whether you are potentially in line to receive something or you are the one doing the planning, proper estate structuring ensures efficient transfers and prevents the legal fees, tax losses, and family conflicts that poorly planned transfers consistently produce. A conversation today can protect hundreds of thousands of dollars in value across a generation. Carol did not know in 2009 that she was standing at one of the most significant financial turning points of her lifetime. She did not know the market was at the bottom. She did not know that what followed would be the longest bull run in American history. She simply looked at the math, recognized that fear had pushed prices to a level that made the long-term case undeniable, and acted while the people around her were frozen. The opportunity today is different in shape, but identical in its underlying logic. $124 trillion is in motion. Millions of new millionaires will be created over the next 25 years. History will record this period as one of the defining wealth events of the century, and most people living through it will only understand what it was once it's already over. You now know the size of what's moving. You know the timeline. You know the mechanics. You know the strategies that put regular people on the right side of a historic transfer. The only remaining question is the same one Carol faced sitting at her kitchen table in the spring of 2009. Now that you know, what are you going to do with it?